What is going on, everyone? Isaiah Henry, First Position Real Estate, and welcome to the First Position Real Estate Live show. We have Kyle on today, longtime friend. And there he is popping in right there. So why don't we go ahead? We'll get Kyle rolling right now, and I'll have him introduce himself there. Alrighty. For all you mortgage people, this is your episode. He's about to drop my fingers out. All right. Oh, there he is.
There we go. What's going on?
Hey. Yo, Battle of the Beards right here. I love it.
Man.
Love it.
You move into the country, you have to grow a beard. That's how it works.
That's pretty much it. That is your ticket price to get in.
You buy a truck and you grow a beard, and that's it.
Yep.
Yeah.
I love it, man. I love it. How are you? How are things, bro? You're good?
Been good. Very busy, very interesting year, up and down on a couple different things, but business is good. People are buying houses, people are refinancing houses. The market is, I'd still like to say it's hot. Things are still happening, and it's just a matter of being opportunistic. People talk about getting lucky, and luck really is when preparation meets opportunity, and you got to be on it. So you got to be on it.
Man, Kyle comes in here hot, comes out alive, 2 seconds, just drops all this. I love it. That's sick. That's my guy right there. That's my guy. So Kyle, obviously I know you, kind of know what you get up to. Give the people a little 30-second rundown, what you got in terms of real estate, mortgages, all that good stuff.
So basically, like, I'm a mortgage, you can call it a mortgage broker, mortgage agent under a multitude of different things. I've been in finance for the better part of a decade, worked with a big five bank, and then eventually moved off into like automotive finance, mortgage specialist, a couple of different finance positions, and ended up back in the mortgage broker role, like the mortgage agent role. And it's been good. It's been very interesting. And I really just focus on trying to find the best holistic approach for customers. So I'm very honest, and some people like to get sugar-coated answers, but I can tell you right now, sugarcoating is not good for you. So sometimes you just got to be straight up with people. I'd like to think I'm as straight up as someone can possibly be while still being professional.
Good. I love it, man. Yeah. That's what you need in a mortgage broker. They're going to tell you how it is, but they're not going to put you in a situation where you're like, but I thought it was like this. And Kyle's like, nah, this is how it is off the top. No sugarcoating. So I love that there.
Yeah, that's exactly it.
Awesome, man. Well, I got 3 questions for you. I'll jump into them real quick so we can get things off to a bang. So let's start with the rates. So obviously, rates are going up. If you haven't been under a rock for the last little bit, rates are going up here. But can you explain the correlation between the Bank of Canada rate and fixed rates and variable rates? Because a lot of people that I've talked to are just like, okay, the bank rates go up. Does that mean my rate goes up automatically because of that? I'd love to hear your insight there.
So it's a three-part question. So first and foremost, the Bank of Canada rate is, if you want to get very basic, is the rate at which banks borrow money from the Bank of Canada. And then they use that money to lend out to their clients. So when the Bank of Canada increases its interest rates, it becomes more expensive for whatever bank that you're using to lend you money. It costs them more money to take that money and lend it out to you. So that's why your personal interest rates end up going up. If you're not currently a mortgage holder, so you're looking to purchase a house or whatever situation, you don't have a mortgage right now, looking from the outside in, you'll see that fixed rates are very proactive, meaning you'll see as soon as there's inklings of rates going up and so on and so forth. I get emails every 5 minutes of rates changing, and you'll see bank goes, RMG goes up, MCAP goes up, TD goes up, Scotiabank goes up. They all just boop, 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 and they all just get emails saying, we're going up at 5 p.m. or midnight tonight or whatever. And that'll happen. You'll see multiple increases in fixed rates in a day, right? That's how they do it. Yeah, oh yeah. You'll see, I've seen banks go 2 or 3 times in one day, but fixed rates going up, fixed rates going up. But that just means if you're on the outside looking in, then your fixed rate opportunity is going up. From a variable rate, I find there's slight changes in what they call your discretion, which is your difference off of the bank's prime rate. But realistically, I find it's a more reactive rate, meaning it's the discretion off prime doesn't change much, usually anywhere from maybe 10 to 30 basis points, which in the grand scheme of things isn't a lot. So it'll go from prime minus 1.2 to prime minus 0.9 or something. So not super crazy difference, but as prime goes up 0.5%, 1/4%, a full percent, etc., then you're going to see big jumps in variable rates.
Gotcha.
when you already have a mortgage, if you're in a fixed rate, it doesn't affect you at all. It just your payment stays the same, your rate stays the same. It's based on the contract you originally signed with the bank for that term.
Okay.
When you're in a variable rate, most banks will increase your payment. So let's say like rates go up and your variable rate goes up and your prime minus 1% or whatever it is. Well, now your $1,500 payment is now a $1,580 biweekly, or for $1,600 biweekly, depending on all the different terms of your mortgage. It's different for everybody. But the only bank that will not change your payment, which is a true variable rate mortgage, is TD. So TD will actually, they'll increase your interest rate. They'll increase the portion of your payment that goes towards interest, and less will go towards principal, but your payment will not change.
Interesting.
So
now,
yeah, I was just say that's pretty convenient for a lot of people, but the difference is TD will make, like, TD's rate will be like anywhere from 20 to 40 basis points higher than everyone else's interest rate, but they'll offer you the opportunity to like lock in the payment kind of.
That's cool. Like, I don't have any mortgage products with TD at this point. Not saying I'm against it by any means, but that's really cool that they have a product out there where you can be variable and, you know, your payment stays the same, because a lot of people, like the average Joe, they buy off payments. They don't buy off price, right? They're buying off a payment. So if that payment can stay the same and, you know, the interest and principal gets worked out behind the scene, that might be a very, very good option, especially for someone looking to get into the market at this rate.
Yeah, it's great for people who are more budget conscious, like they care more about their like monthly cash flow or biweekly cash flow, versus someone like me, for an example, who I could say I'm a little riskier than someone else, or whatever term you want to use. I still go with like a traditional, what some banks will actually call an adjustable rate, meaning your payment will change. Because in my opinion, I still believe that's the better option, because historically when rates go up, they're high for 12 to 18 months. So even if your rate's gone up 2%, it's probably only going to stay that high for a year to year and a half, meaning you're going to have 3.5 to 4 years of your mortgage term still in the lower rate environment, because they're not going to stay high forever. So when you have that type of payment, which is what I elected for my mortgage, yeah, sure, my mortgage payment goes up, but I'm less concerned about my cash flow and more concerned about my overall interest costs at the end of my term. So that way, at the end of 5 years, I will have more interest, or more principal, paid off of my mortgage than I would the other way around.
I like that. That's good. And like, I think you did a great job breaking that down. Like, there's not like one size fits all. It's not like you have to be fixed, you have to be variable. Like, there's different situations that kind of can go between both those rates, but it's important to speak with that mortgage professional so you get that kind of good overall look at that there. Anything else you wanted to add on that point?
It's really just a matter of like, what's your personal preference, and sitting down and talking to someone. And like, my biggest thing is just take someone's advice. Like, if it makes sense and they show you the numbers and they go through, take their advice. Because a lot of times, like, I don't want to say like you need to listen to us, but we are professionals and we give you advice based off of years of experience. So if there's a difference between talking to like a mortgage professional and a real estate professional, so on and so forth, and your mom or your dad and when they bought a house 20 years ago for 16 raspberries or something, right? It's just crazy. So
no, man, that's such a good point. Like, I get so many people like bringing me all this like real estate or financial talk. I'm like, okay, like what is your role in this? Like, oh, I don't own a house, I've never bought anything in my life. I'm like, how are you giving me all this advice on a topic you know nothing about? So that's I think a good tip right there.
Yeah, like a lot of people go like their parents, and yeah, like I say, like trust your parents and stuff like that, because they have like this, sometimes they have your best interest at heart. But at the end of the day, like, let's say your parents have been busy, or your aunt or whoever has been busy in the real estate market, and they've done 10 transactions. Like, I've done 10 transactions this month. Right. So it's realistically, like, we see these things and we're paid to be professionals. So that's probably my biggest thing, is just like, take some serious advice. But at the end of the day, if the advice you're getting doesn't pass the smell test, then realistically you need to like find somebody else.
I love it there. Let me move on to my second one here. So this is a topic that I really don't know much about, but I haven't really had to touch. Knock on wood, I've just been in a good position. How is the importance of credit scores? Like, where does that go into qualifying for a mortgage? Is it like there's a certain threshold? If you're below it, no mortgage. Above it, you get one. How does the credit score play in?
So if we're talking like A lending is usually it's very difficult to get any type of A lender to look at you if you're under 600. In terms of like a beacon score. Most A lenders want at least one person on the application to be 650 or 680 or higher. As if you're 700 plus, then you're kind of gravy. You're kind of in like a really comfortable zone. But I usually tell people we want to shoot for at least like 680. Some banks are cheeky and they'll say 685. But if you want like a no hassle from an A lender, usually a 680 is where you need to be. The benefit of having the higher credit score is one, of course, you get to go with an A lender, so there's less requirements and like better interest rates and no fees up front and stuff like that. But realistically, it comes down to like making sure you have those things like set up ahead of time. If you have lower credit scores, then you're looking into different types of lending, whether it be alternative lending or so on and so forth. But now you're also into a conversation where you need to have like a 20% down payment, 25% down payment. So it's definitely very, very tough, but super important to keep your credit scores high. And one of the biggest things that I see is like, I think someone just commented like 700 plus for rentals and stuff like that. And it's honestly true, right? So you need to have those like higher credit scores. Is there options and stuff like that? Yeah, for sure. But you definitely want to be in that like 680, 700 plus.
Good stuff. That makes that makes sense. Like again, like everyone has a different credit score, different credit situation there. But I'm glad to see there's options for both those people with like super high credit scores or people with credit scores that aren't so favorable. Just before we get to that last question, there is there anything that you've seen maybe in like a 6 to 12 month window that someone can do to move their credit score a little bit higher to maybe hit that 680, 685 if they're sitting at like a 650, 640 range?
Honestly, my top options really for most people is first, of course, like one, any type of collections or outstanding like bad debts, they call it, like get it cleaned up. Like whether it's you settle with it, whether you pay the whole thing off, like whatever works, you definitely need to make sure those things are cleaned up, because otherwise it's a really hard argument to go to a bank and say, oh, they're totally going to pay back their $500,000 mortgage if they couldn't pay back their $400 Rogers cell phone bill. It's a very hard conversation to have. There's ways around it, but realistically, just make sure it's paid off. Secondly, it would be making sure you make all your payments, and how all of my stuff is set up and how it's always been set up since my first credit card at 18 years old is the minimum payment comes out of my bank account automatically. So even if I'm slow or I forget it or whatever it is, then I've never missed a payment. Like I've literally never missed a credit payment in 12 years, all because if I get a credit card, you give them your direct deposit information and the minimum payment is set up. So that way, you're never missing a payment. And so worst case scenario, you pay some interest on a credit card or something like that. Then lastly, from what I'm seeing based off, I use Credit Karma, I keep an eye on everything, and I definitely do like it as an app. And one of the advice that I got from Credit Karma, which I tend to like share with people, is if your revolving utilization, so not including like car loans or mortgages or so on and so forth, but credit cards, lines of credits, those types of things, if you keep that utilization under 30%, so if you have like $10,000 worth of credit cards and lines of credit, if you keep your revolving monthly balance or average rolling balance or whatever under $3,000, then your credit score is actually going to either go up, or if it's already high, it's going to maintain. So that tends to be the magic number for what I'm seeing. So make all your payments, at least the minimum payments, clear up any type of collections and stuff like that, and try to keep your revolving debts under 30% of like your total available credit.
That's awesome. That 30% one, that's going to have to be a tool, because I never knew the number, because like, especially as you get into the investing world, that access to capital, so lines of credits, credit cards, you're putting a lot of stuff on. Not that I don't have the funds or that an investor doesn't have the funds, but sometimes there's that gray area. Do you max out like, one thing for like 100%, and then leave everything else? Or is it better to kind of spread that out to be about 30% across your available balance?
I would spread it out. If I'm being honest, if you had to get into that, it looks a little bit better than having like a really high limit on it, or having a really high like balance close to your limit on any particular card. I usually don't recommend dipping into like revolving credit and stuff like that. If you're looking for like closings and stuff, it's definitely like a last minute worst case scenario. But I would definitely keep like utilization like on any individual card, like lower than 30%. Whether, like I said, whether it's a line of credit or a credit card or so on and so forth. Definitely super important to keep that lower. And as long as you have that, you're in a pretty good spot. And one thing that people make the mistake of, which is actually, it sounds contradictory, but if you have a third credit card that you never use, don't close it. If it's got an annual fee, switch it to the no fee credit card. Just leave it. Throw it in the drawer, or throw it in the back of your wallet or whatever it is, or cut it up and never use it. But don't close it, because now you're automatically reducing your revolving credit limit, which means whatever balance you did have is already at a higher thing. So I've seen people close their credit cards and their credit score went down. And they're like, "What do you mean?" And I was like, "You're technically using more of your available credit. So even if it's a $5,000 card or whatever it is, and you just don't use it, just cut it up and throw it away, right? But just don't close it. Don't close the account unless it's a credit condition or something like that for a mortgage. Don't close it. Just leave it."
That's a great tip. That is the great tips. I know there's tons of people out here, investor wise or consumer wise with credit, and it's a tough topic. No one's really like taught that or served up how to really use credit well. So this is some great tips, I think, for everyone here. Let me jump to my last question, because this is one everyone likes. So a lot of people getting self-employed, side hustles, realtors, mortgage agents, whatever you call it. What are some options for them in terms of mortgages and financing? Are they like no A lenders? Like if you're self-employed, can't do an A lender? And if that's not the case, what are some of the options?
You definitely can do an A lender. How I usually look at it is ultimately just, it's either you want to claim as much income as possible. When you're coming into lending, you want to claim as much income as possible. But at the end of the day, we need to show the money is somewhere. So whether it's on your line 150 or your self-employed income, like reduced self-employed income, or in the business bank account or on your business financials, it's got to be somewhere. Because if you have a terrible line 150 or like completely reduced income, and there's nothing in your bank accounts and there's no savings and there's nothing, guess what? In the bank, according to the bank, you have no money. So how are we supposed to give you any more money if you can't show me that you have money? So I've had situations before where a client, like let's use a corporation for an example, it's like an incorporated client. So they've paid themselves like $20,000 a year, but the business did like over $500,000 over the past few years. Bank accounts were pretty healthy. He had savings. He had 20% down. So like really good situations, but like didn't really claim a lot of income. But the business did. It had solid retained earnings, solid net income. And how it basically worked out was we actually got him approved with an A lender rates, like so on and so. It worked out pretty well. But he was able to show some sort of money on paper, versus I have other people that they don't show anything on paper. And it's very, very difficult to make that argument if you can't show me anything. Gotcha. So if you're self-employed in a corporation, then of course, like pay yourself as much as you can. You get to control your income perfectly. Secondly, make sure you have retained earnings. Make sure you're putting stuff through your bank account so I can show that there's actually money rolling through the business and things are moving. And last but not least, like make sure that you have you're actually claiming everything that you're putting through that business. So even if you write stuff off and so on and so forth, that's great. But as long as the revenues are good, net income is pretty good, retained earnings are good, and there's money flowing through the bank accounts, we can put you in a pretty strong position to go forward. When it comes to like sole proprietor clients, a lot of times you see a sole proprietor and it's not line 150, it's like self-employed income on the T1 general, but you'll see gross business income and then net business income. When let's say someone in their sole proprietor made $100,000 and they reduced their income to $25,000 or whatever it is. Most A lenders will look at that $25,000 and look at the gross and say, can we gross up that net income by 15 or 20%? And then that's what they'll use for the application. So it's
Okay.
difficult because they're putting themselves in a position where they're writing off so much income. Then the next step is trying to show all the bank accounts, showing all the cash flow coming through a bank account, and show that there's more money there. So it's pretty difficult when it comes to sole props. But that's why a lot of times when it's self-employed people, it's either one, a lot of like preparation of like maybe it's a couple years preparation or whatever it is to like make sure you're ready to buy a house, or it's really just like try not to avoid paying taxes. Because if I'm being honest, until you're making $200,000, $300,000, like taxes aren't that high, right? And if you put on like I think the number is like, don't quote me, I'm not an accountant, but I think if you make $100,000 or something like that, I think your taxes like tax payable is only like $20,000 or $30,000. So you pay your $20,000 or $30,000, but now you get to claim $100,000 of income, which gets you on your own $400,000 to $450,000 in mortgage. So if you look at that trade-off of let's call it $25,000 or whatever the number comes out to be versus $450,000 in income, you're basically just like investing in yourself. Yeah. And then once you have the next property and you do that for like 2 to 3 cycles of buying properties, now you got a couple rental properties and you just roll. Right.
That's it. I like it. There's another guy, I forget his name. He was making the same case for that. He's like, yeah, like you guys, like you show no income and you think you're all big and bad. Like, you know, if you're sticking it to the tax man and then you go try to get a mortgage, the bank's like, man, you're poor. I'm not giving you any money. And you're like, what do you mean? I'm not poor. I show no income. But you did a real good job of like kind of illustrating, yeah, you can show no income, but that's also going to hurt your ability to qualify in the future. So that's perfect.
You got to show it to me somewhere. Like you say you make money. Okay, show me you've made money, because it needs to be on paper, right? It's not, this is like back in like the early 2000s and like the 90s and stuff like that. They used to be able to do stated income. There's now stated income's like a completely different definition, but you used to do stated income. So you ran a convenience store or whatever it is or you sold jewelry under a sole proprietor or something like that, and you just go to the bank and be like, I make $150,000, and they're like, okay, here you go, here's a mortgage based on $150,000. And nowadays you can't do that. You can say, yeah, I make 150. It's like, okay, so let's see, show me, where is it? And so it's definitely a different environment now, but ultimately it just comes down to like, what do you want to do? Do you want to not pay taxes, or do you want to like invest and get action and leverage whatever income you do have to make even more income?
That makes sense. I like that. I feel like that's like a really good way to put it, like to kind of frame it in a way like, hey, it's not impossible. Like all that, you know, jargon or garbage out there is like, well, if you're a sole proprietor, if you work for yourself, you're never getting a mortgage. I think that's all BS. Like there's ways to do it, but like you said, you got to show me, you got to plan, you got to talk to a professional and get yourself in a good situation to make this thing happen.
Yeah, and that's really it, right? I look at it like you need to show me something, because everyone talks about, and I usually have this conversation with like people who are a little bit older, but basically what it comes out to is they come in and they say, oh, well, my house is worth $1 million. And it's like, okay, well, like how much income do you have? Well, my house is worth $1 million. Okay, explain to me how $1 million house makes mortgage payments, like physically transfers money into the bank's account to make your mortgage payment. And they say, well, I'll make the mortgage payment. Okay, so show me how. Where's your income? Right? Mm-hmm. And the best, I heard this stuff actually like not too long ago, out of all the years I've been doing this, and someone said a mortgage is a loan against your income, which is secured by your property. Meaning if your income can no longer support the loan, they will take your property. But it's not a loan against your property. Yeah, until you're older and you do chip mortgages and reverse mortgages and stuff like that, you have to show income. You have to show me how you can make these payments back to the bank.
I like that a lot, man. Yeah. That's huge. So many freaking golden nuggets. I love that. There's so much I gotta unpack there. Before we go, did you have any questions for me or anything you wanted to add before we kind of wrap it up here?
Honestly, it's really just coming down to like keep doing what you're doing. I see like you're putting out as much like educational content as you can, and that's really the biggest part of it. And I found that's what got me a lot of success was doing the Lawson whiteboard sessions and those types of things of just giving out the information. Because if this probably goes for anybody in any type of industry, in any type of business, that business is like infinite. Money is infinite, and it doesn't exist. Like you said about Wall Street. What was it? Wolf of Wall Street. They say like money is fugazi. Well, like money and deals are fugazi, right? And what that means is just because somebody else is getting business doesn't mean they're taking business away from you. So if you're worried about giving out something for free, there's a difference between doing stuff for free and giving out stuff for free. But as long as you give out stuff for free in the right way, then you're going to put yourself in a position where like you'll get that stuff in return.
Yeah.
Exactly. If you're scared to give things out, that means you're worried that things are never going to come in, and you're sending out the wrong message to the universe.
Definitely. Yeah. Definitely. And I really felt that off your vibe, like the kind of just how you've carried yourself, your business, your brand. I'm like, oh, like it's just like overflowing. Like there's so much value coming out. Like it's almost like it's impossible not to see how much that, like, you know, you flow out so much, like so much will come back. And I can see it in your business, the way things are going. So I love that. I love that a lot. Yeah.
The river is never worried where the water is coming from. It just keeps flowing. It keeps flowing in one direction. So just keep going.
Good stuff. I love it, man. Well, let me wrap up here. You know, it's Isaiah Henry, First Position Real Estate. We had on Kyle today. Super great episode. A lot about mortgage finance and everything in between. Kyle, if people want to, you know, get a mortgage or just learn more about the industry or understand their positions, where can they reach out to you?
Instagram is usually really easy. The Instagram also links to my website, which is a contact me page. So it's got all my information there. But if you're on Instagram, just feel free to DM me. I'm always on Instagram. I'm always available. Always willing to chat.
Good stuff. And you guys have to message him. Just let him know he has the second best beard on the live, so I can, you know, get a little love from me. I'm just kidding.
There you go. It's good.
Thank you. Thanks so much for joining me. I really appreciate it. Just wrapping up here. My name's Isaiah. Like I said, I help government employees invest in real estate so they can build wealth, retire early. Had on Kyle today. Had a great episode there. Kyle, thank you so much for joining us, and we will see you next time. All right.
Thanks so much, guys.
See ya.
Take care.